The market reaction to FOMC's rate cut yesterday followed a distinct two-phase pattern to that showed the difference between the policy statements and the Fed chair's communication. Initially, the market was there was a dovish reaction to the Fed, and we saw a surge in Euro USD above the 119, a multi-year high, following the rate cut, and of course the summary of economic projection, the dot plot that showed a more aggressive easing this year and also next year. There was 50 basis points of cuts for 2025. This means we are going to see cuts for at every subsequent meeting we are expecting this year versus just 25 points. Of course, some of this was priced in, and we don't know whether markets are really going to how long it will take to price in the entire cut. But keep that in mind for the medium to long term view. Now, this dovish shift, of course, sparks an immediate spike, right? Within the hour, we saw the prices moving up on Euro USD above 19 and then fully reversing. After, we saw Powell kind of taking a way more hawkish stance during his statement. He said that he doesn't feel the need to move quickly on rates. And he did actually label as the cut of September more like risk management cut rather than a start of an aggressive easing cycle. The conclusion still is that the Fed has finally pivoted, okay, but the upcoming meetings are becoming more important for Euro USD since the Fed is more critical currently for Euro USD price action, given, of course, the ECB is going to hold, which suggests some sort of upside for the euro anyway. But it makes the next FOMC meetings more and more important, since also Fed Chair said they are going to be taking decisions meeting by meeting. So I think, given where we currently have fallen down to, finding support at the previous high at 117.78, it's exactly that, actually retest, we could see indeed a move to the upside, but I think it's going to be probably a retracement, okay, just a simple pullback. And I do see this as some sort of perhaps like a dead cat bounce, okay, and I will go closer. I just wanted to begin with showing you in the charts that this is the 100 Fibonacci extension of the longer term move from down the 114 or so level, shy of, back in August. Okay, so we extended 100% of the Fibonacci level. We came all the way down to the support now. So next level, if we do break below that low, indeed, is going to be, I think, the swing high at 117.40. We wouldn't want to go below that level for the bullish bias to remain intact. Okay, of course, rejections doesn't necessarily mean we're going to see upside, but we prefer to see this move. Of course, once we see where exactly we could go, 118.30, we prefer to see this move to the downside, not really going beyond the 38.2. I would say 117. That would be our last point. How I see this transpiring to the markets, I see something like this, perhaps, right? And then, of course, further continuation to the upside. Without that meaning this is going to be, of course, it's not the base case. This is what I think is going to happen. We will know more once and if we see this move to the upside stalling. Now, for a dead cut bounce, right, this should and better stop at 38.2, at around 1832. However, the 50 and 61.8 are also a possible scenario, but they're going to reduce the chance of this being a dead cat bounce. That doesn't necessarily mean that we're not going to see further downside, because we don't just have one pattern that we follow, but it could mean that simply we might see a different pattern play out. One way or another, okay, we have to pay attention to these numbers. Okay, I am interested also looking at the daily, because the daily levels are quite important. The close the day prior the FOMC and the open of the FOMC day and the close of the FOMC day, and of course the open of today. All of these levels are quite important alongside the high momentum candle open on Tuesday, down in the 1 hour. These are the levels that we have to play with. So you see the 61.8 becomes a cluster, okay, with a daily open or close, and the 61.8 Fibonacci retracement. I am looking for perhaps a move up to that level and further continuation to the downside. This would mean that I would be looking for short positions to enter exactly at that level, pretty much. And um, of course, markets could turn below and the entry can change. Keep that in mind. But the main point is that if this plays out, if prices comes here, would be looking for shorts with a with a stop above the 17.8. If we do break above that level, it's likely we'll continue higher. And a target, that would be the entry supposedly. Sorry, that would be the Fibonacci extension, the entry over here, with a target at 117.50 and ultimate target, okay, at 117.30. Okay, so as you can see, this is a good risk reward ratio that we will be looking at 3.38. And of course, partial breakouts, partial takeouts are always recommended. We have to see how the markets close today and tomorrow, okay? And maybe this will be triggered, maybe no. Only then do I see prices moving higher. Now, if we do break, of course, and continue above the 118.66, this is a very critical level, guys. I think we will be heading higher. And then you might ask, where are we going to go? Well, I have also here the weekly chart, okay? And I pull just a simple trend line, and you're going to see that further upside is possible, but it's going to be limited below the 120 level. Initially, there is a very high likelihood that we're going to see a rejection at this level initially, okay? What this means is any move to the upside, okay, we are looking at potential Fibonacci levels. If the 141 is above the 120, we're going to look for 131.8, 32.2, so 38.2, sorry. That brings us to 120. Also, the 120, of course, handle, and then we would be looking at the 105. You might ask why. Well, in Elliott wave terms, that's 119.40, okay? In Elliott wave terms, the 5% move indicates a flat pattern, whether it is actually a regular pattern or an expanded pattern. So that's what I will be looking. Another thing that I would like to do at this level, since we are looking at this price action with different views, okay, would be looking at the neckline, the potential head to neckline distance that comes from a inverse head and shoulders potentially, and that would be something like this. Okay. Oh, it looks like I just made that go away. Okay, not really ideal structure. but well, we are in forex, we are in markets. So what I would be doing in this particular case, guys, we're going to measure the distance from the bottom to the neckline. That's a 3.25% increase. We can put this down at the breakout level, which is actually around the 117, and we're looking at the 121 level. Okay, so in case we manage to break above the long-term trend line, okay, and this is more of a long-term situation, I think, then we'll be looking at around the 121 level. So we haven't talked about indicate potential triggers for upside. So what I would be doing essentially is we're going to pull the Fibonacci level over here. Okay, we have the 38, which currently acts as resistance. Okay, if we're going to see an upside, ideally we want to see this coming into a gradual sort of price action and correct orthodox price action. So we'd be looking for initial leg up to 23.6, then down 38.2, and then further potential continuation to the upside. So we'll be looking at entering, yeah, the pullback at 38.2, which means the stop loss just below the previous low, take profit. The first one would be around the previous high, and then we would be looking, of course, for the extension coming up to the trend line of the daily to ensure that we don't have this target exceeding, beyond that potential resistance.